$200 per month per unit cash flow on the market in Bryan, Texas. It crushes the 1% rule. Sorry to burst your bubble, but you're making a rookie mistake. And don't worry, you're not the only one. I've been investing in real estate for 8 years. I spent 3 years as a property manager with over 150 units in my portfolio, and I've been a licensed real estate agent in Bryan and College Station for 6 years. I've made almost every rookie mistake in the book, and I've watched hundreds of other investors make them too. So in this video, I'm going to share some of the more dangerous rookie mistakes that we see out there and what you can do to avoid them, including how to spot a deal that looks sexy in the spreadsheets until you see it in the streets. So let's get into it. I'm breaking this down into 3 different categories, 3 mistakes that I see first-time investors make over and over again here in BCS. And look, these aren't dumb people. These are smart people who did their homework. They just lack some of the experience. And to be real, I've made all of these rookie mistakes and I survived. So don't sweat it too much. Mistake number 1, who's on your team? Rookies do this all the time. They underestimate the importance of their team. This is your group of local trusted advisors who should be helping you find, analyze, do due diligence, finance, buy and manage your property. But here's what we see. Investors find a deal on Zillow, then they reach out to whatever random agent Zillow is advertising. They get pre-approved with the first person who comes up on a Google search, and then they go with the first property manager they find. Then that's their team, and it can work. It's just not how you maximize your ROI. The difference is huge over time. When you're buying a rental property, especially from out of town, you need a team of people around you who you can trust, who actually invest. Your agent should own rentals. Your lender should understand how rental income works in a debt-to-income calculation. Your inspector should be able to look at that 1978 built fourplex and not just check boxes, but actually advise you on what issues are important to an investor, what really needs to be fixed. And your property manager should be providing you with rental comps along the way. They should want to be involved in this process. If they don't care about you now, do you think they'll care about you when it really matters, when they're in control of your biggest asset, your investment? Of course, if you're planning on self-managing, then you probably care more than anybody else, which in my opinion is half of the battle. Take your time with this. I didn't, and it ended up with a house that my property manager needed a gun to go into. So don't rush this step like I did on my first rental property, which was a huge mistake. And the result was a property that was so rough, my property manager needed a concealed gun just to enter. We ended up selling that property. Go figure. This rookie mistake is for all of my nerds out there. If you're proud of your spreadsheet, you're probably exactly who I'm talking to. You're probably about to make the second biggest rookie mistake. Pull your head out of the spreadsheet, open your eyes, and evaluate the physical asset you're about to buy. Because houses don't perform on spreadsheet. They perform in the real world. And in the real world, the street matters more than your calculation. Think about it. Amazing house, great price, but there's a meth house next door. That deal is not going to perform. I don't care what the calculator says. And I can't tell you how many times I've had this conversation with out-of-town investors who run the numbers 6 ways to Sunday. They know rent comps, they know the cap rates, they know the gross rent multiplier, and they have never once looked at the street the house is on. Guys, the street matters a lot. And look, I get it. You're in Dallas, you're in Houston, you're in California. You can't just hop in a car and drive to Bryan every time you see a new listing. So here's what we recommend. You do an area tour early in your process. Before you even look at specific properties, just come out here, drive the major streets. Let the agent that you're working with show you the neighborhoods and why they're priced the way they are. Because once you've done that, it will click. You'll get it. And here's something that surprises a lot of first-time investors. The areas with higher prices and lower ROI, it's not a bad deal, that's lower risk. You're paying for stability, you're paying for better tenants, you're paying for less vacancy and less turnover, and that's worth something. The rookie mistake is chasing the high ROI on paper without understanding what you're actually buying. Would you rather get a guaranteed 12% or a risky as hell 18%? Investors should not be gambling. They should be making calculated decisions to grow their wealth over time. So if you can't get here in person, what do? Well, in the meantime, pull up a Google Street View and walk the block. Literally, click your little way through, look at the streets, the cars, look at the yards, the condition of the neighboring properties, run a crime map. Ask your agent not for photos of inside the house, but ask them to send you a video of the street in both directions. That will tell you more than a spreadsheet ever will. But nothing replaces that area tour. Build it into your process early. You'll thank me later. We love those area tours. We love giving them to our clients. So we might be a good fit for you if that's something you're looking to do. You can always send me an email with the word START to info@schwartzrealtygroup.com to get the conversation started. Your numbers for your property analysis, they're made up and you know it. and it's gonna bite you in the ass. Welcome to the third rookie mistake. And I'm not saying that you're lying, I'm saying that you're using generic percentages from a YouTube video or some TikTok guru, and you're applying them to a specific property in a specific neighborhood, and that's not underwriting, that's wishful thinking. Here's what I mean. Let's say you buy a 1980s built fourplex and you plug in 5% for maintenance. Well, that sounds reasonable, right? And the calculator says that you're gonna cash flow $400 a month. That's a good deal. Except that 5% number came from some guy who's making his own deal look good so he can get clicks on Insta Twitter. It has nothing to do with that actual 1980s built fourplex in Bryan, Texas. People love that 5% number. Let's play it out in real life. 5% on that duplex is about, well, $50 a month. In my experience, that's about $150 less than what you actually will spend maintaining an 80s built fourplex unit. So there goes your cash flow. And I know this because I have real world experience with fourplexes. I've managed them and I own them. And I'm replacing another bathtub that's gonna cost me about $3,000 to do the upgrade. That's a real world expense. It really matters and it really affects your cash flow. Generic numbers are fine for your initial back of the napkin math, but before you make that offer, make sure you refine that and you're accounting for the actual vacancies and the actual maintenance that affects that asset. And of course, if you listen to mistake number one, you'll know that your experienced team can provide those numbers to you so you can have better analysis. Rookie investors in Bryan and College Station lose money because of these three mistakes. They rush building their team, they run analysis but don't look at the actual street the house is on, and they use generic BS made up numbers when running their analysis before making an offer. But you won't do that because you watched this video. And if you want to avoid other mistakes and learn more about investing in our great local market, you're going to check out this video next.